Okay, let's unpack this.
Let's do it.
We are diving into something truly monumental, a financial event that went from just a quiet market trend to this full-blown economic migration.
And so suddenly, it completely blindsided Washington.
It really did. We're talking about an unprecedented flight of capital, billions and billions of dollars, moving away from traditional U.S. markets.
And heading straight into the emerging powerhouses across Africa.
It's just a massive story.
It really is. And, it's hard to overstate the speed and just the sheer scale of this shift. If you look back, the earliest quiet signal, I think we had it around 2020.
Oh, you're talking about Jack Dorsey, right?
Exactly. You had Jack Dorsey, the co-founder of Twitter and Square, spending months in Africa. That was a sign that for next generation tech and finance, the focus wasn't, necessarily India or China anymore.
Right. For decades, the thinking was, if you want to tap into these huge youthful populations with massive mobile adoption, you look east.
That was the playbook.
But Dorsey was basically saying, hey, look over here.
Yeah.
That Africa had matured its mobile infrastructure to a point where it offered a clearer, maybe less regulated path to growth.
It was a subtle signal, for sure, but the big institutional investors, they were paying very close attention.
And that subtle signal became a flood.
It absolutely did. What some analysts at first were dismissing as, minor portfolio diversification.
Right.
It escalated so rapidly into this massive, abrupt reallocation of funds. And we're not talking about small-time funds here.
No.
We're talking European sovereign wealth funds, major Asian insurance groups, and Middle Eastern investment houses pulling capital out of U.S. treasuries and high-cost tech stocks.
And just pouring it into Africa.
Aggressively into things like African infrastructure bonds, specialized mineral development, manufacturing, renewable energy, you name it.
So the mission for this deep dive is to figure out not just what happened, but to really analyze the seismic economic logic behind it all.
The why.
Why? Africa's rapidly growing strengths directly contrasted with America's surprising and frankly new weaknesses. We have to shed that old perception of Africa as just an experimental frontier.
That old narrative is completely obsolete. I mean, it's irrelevant now. Africa has, almost overnight it seems, transformed its profile from a place seen as high-risk, volatile.
To what?
To one of the most promising, stable, and future-oriented investment destinations in the world. That turnaround is really the core of the story.
Okay, so let's start with the pull factors. What were the concrete, undeniable reasons that drew all this capital in? Because these huge investors, they don't move billions on just a good story.
No, they move based on hard numbers and strategic guarantees. And honestly, the sheer rate of return was the initial magnetic force.
The numbers were just that good.
They were incredible. If you look at the data compiled by the UN Conference on Trade and Development, they noted that between 2006 and 2011, Africa offered the highest rate of return globally on foreign direct investment FDI.
And that rate was what?
It was 11.4%.
Wow. And just to pause for a second on FDI, we're not talking about people just buying stocks here.
Yeah.
This is different.
That's a great point. No, this isn't just portfolio investment. FDI is money invested in building things, factories, pipelines, power plants, real long-term assets.
So when you see an 11.4% return on that,
compared to, say, 9.1% in Asia or 8.9% in Latin America, it tells you two things. First, the infrastructure gaps were so large that every dollar spent had a massive impact. And second, the growth trajectory was just exponential. It wasn't restrained by the saturated markets you see in the West. That kind of performance, it doesn't just attract attention, it dictates global strategy.
Here's where it gets really interesting for me. It wasn't just passive returns. African nations were actively rolling out the red carpet.
They were incredibly aggressive.
Offering specific, tangible incentives that the U.S. just couldn't match because of its own regulatory burdens and tax structures.
Exactly. They moved beyond just vague promises. We saw these very aggressive, tailored packages.
Like what, specifically?
Things like tax-friendly industrial zones that guaranteed low corporate taxes for decades, long-term profit repatriation guarantees, and dramatically streamlined regulatory transparency.
And the cost must have been a huge factor, too.
Oh, huge. The operating costs, labor, land, energy, were significantly lower than what you'd find in New York or London or San Jose.
But the old problem for Africa, the thing that always held investors back, was that perception of instability. Political risk, corruption, contracts not being honored. How did they get past that?
They faced it head on. And this is where the genius of their strategic transformation really lies. It wasn't just one country, it was a continent-wide effort.
Okay.
They achieved extraordinary progress in political stability. They focused on energy independence, on modernizing agriculture, and building up their own tech manufacturing. These were deep structural changes.
And the final piece, the thing that must have been the ultimate confidence booster, was that continent-wide investment protection framework.
That was the absolute game changer. It was the single most crucial development in restoring trust.
Because it wasn't just a piece of paper.
No, it was a real legal and financial mechanism. It guaranteed security for foreign investments by setting up independent arbitration courts. It enforced stable, long-term contracts. And it created corruption-free financing channels overseen by external auditors.
So it basically eliminated the biggest historical risks.
It did. Suddenly, African assets didn't just look promising, they looked reliably secure. Safer in some ways than Western markets.
Okay, let's transition then. Because this shift wasn't just about Africa offering better incentives, it was about Africa changing the rules of the game entirely.
Yes.
They moved from being passive recipients of capital to actively setting the terms of engagement through what they call domestic value creation.
And this is the pivot that really challenged decades of American control over global supply chains.
Yeah.
For so long, the model was simple.
Very simple. African nations export raw materials.
Right. Ore, cobalt, lithium.
And then they import the finished goods, batteries, cars, electronics, at huge markups.
They basically decided to stop selling the doot and start selling the finished products.
Exactly.
They started building their own processing plants, their own refining centers for these critical minerals. So instead of shipping raw lithium to Asia or North America,
They started building the capacity to process it into battery-grade chemicals right there on African soil.
precisely. And that immediately captured this massive amount of value that had traditionally just left the continent.
And they made this mandatory, didn't they? This wasn't just a friendly suggestion.
Oh, absolutely not. It was a new contract term for the global economy. They launched continent-wide value-add requirements.
So if you wanted their minerals,
If you, say, a major car manufacturer, wanted access to African copper or iron ore, you had to commit. You had to help build the factories, the research labs, the training centers, right there.
they were forcing global capital to build local industrial infrastructure.
Yes. Which sounds like a tough bargain for some of these big American corporations that were used to total control.
I'd imagine.
It was. The old system, where profits just flowed almost exclusively to Western corporations, was officially over.
And how did the world react to that?
The reaction was split, really. Investors from Asia, the Middle East, and Latin America, they rushed to comply. They saw the long-term strategic advantage of securing access,
They prioritized access over control.
They did. But the American corporations,
They hesitated.
they hesitated. Many U.S.-based firms operated under this deep-seated assumption that Africa would eventually go back to the old rules.
So this was temporary.
Exactly. They expected preferential treatment or waivers, and that inflexibility, that hesitation, it cost them tremendously.
They lost out on contracts.
They lost out on huge long-term contracts for mineral access and processing rights. Those went to their more adaptable Asian and Middle Eastern competitors, locking U.S. firms out of crucial sectors like battery manufacturing.
And to make themselves even more appealing, we saw the creation of these African investment clusters.
Yes, that pooling of resources was strategic genius. Instead of an investor having to negotiate with 54 separate countries.
They could engage with one regionally integrated economic district.
Right. Countries were pooling resources to build shared industrial hubs, research centers. It reduced the risk profile for investors and provided scale almost immediately. Washington's old strategy of dealing with fragmented markets just became obsolete.
Okay, we have to pivot now to the other side of the coin, the push factors. Why were investors fleeing American assets so abruptly?
Because the opportunity in Africa was massive, yes, but the capital flight was made worse by deep structural problems back home in the U.S.
The perception of the U.S. economy it shifted.
It shifted from being the global safe haven to being seen as an unpredictable, high-cost zone. Investors were looking at the massive U.S. national debt,
The inflation that just wouldn't quit.
the inflation, a stagnating industrial base. But the real killer of trust, I think, was the political volatility.
The constant infighting that just kept bleeding into economic policy.
Precisely. Long-term investors hate uncertainty more than anything. And they saw this endless cycle of political battles, the threat of government shutdowns, the inability to pass meaningful long-term
The
reforms.
brinkmanship over the debt ceiling, again and again.
Yes. When you are planning a 30-year infrastructure bond purchase, that level of unpredictable policy is poison. And Africa, almost paradoxically, started offering more policy clarity and more potential for expansion than the United States.
I can absolutely see that investor fatigue setting in. It must be exhausting to constantly guess what the Fed is going to do or if Congress is going to cause another artificial crisis.
Analyst reports from that time called it policy whiplash. In the U.S., you had high operational costs coupled with volatile interest rates and unpredictable tax policy. Meanwhile, Africa was offering stable, long-term tax guarantees.
And what did that mean tangibly for the U.S. economy?
It created these growing funding gaps.
Yeah.
States, municipalities, they rely heavily on foreign capital to finance everything from highway maintenance to innovation projects.
And that money was drying up.
It was being redirected to Africa, so you saw delayed projects, funding freezes for tech hubs, and major American corporations started seeing stock declines as funds were shifted to African-based companies that were promising higher growth and lower costs.
The verdict was in.
The verdict was in. Investors concluded American markets were, and I think the quote was, oversaturated, burdened by high costs, and restricted by political uncertainty.
And Washington tried to fight back, didn't they? They offered new incentives to try and draw that capital back.
He did, but it was a failed effort because they didn't address the underlying issues. They could offer tax breaks, sure, but investors were already tired of promises that might just be reversed after the next
The
election.
trust was gone.
The trust was gone. They saw the deep divisions in American governance, and they chose the clear policy frameworks being offered in Africa instead.
Okay, moving into what might be the most critical part of this story. The strategic moves that allowed Africa to move beyond reliance on the dollar system. This is what truly terrified Washington.
Absolutely, because Africa wasn't just looking for investment, it was aiming for genuine financial independence.
And the biggest step was that unified African investment exchange.
It was a technological and financial gateway that allowed global investors to buy and sell African securities, stocks, bonds, futures directly.
Without needing to route those deals through American or European banks.
Exactly. No intermediaries, no clearinghouses in New York or London. That single move fundamentally threatened U.S. control over the global flow of capital, which has been the backbone of its power since World War II.
And it signaled to the world that Africa had the infrastructure to manage its own capital markets.
It did. And suddenly, big international corporations felt comfortable enough to relocate entire factory lines, regional headquarters, R&D hubs,
Out of European and American cities and into these new African industrial corridors.
triggering measurable job losses in the high-cost West.
But if we connect this to the bigger picture, the most painful blow, as some called it, wasn't even the loss of jobs. It was the direct challenge to the dollar.
Oh, absolutely. That was the real earthquake. The investment exchange was followed by their most aggressive move. Africa and several major Asian economic blocs launched a joint financial settlement system completely independent of the dollar.
Explain how that works and why it's such a massive threat.
Well, traditionally, almost all major global trade, even between two non-U.S. countries, had to be cleared and settled using U.S. dollars, usually through American banks or the SWIFT system.
Which gives the U.S. enormous leverage.
Enormous.
Oh.
This new system just bypassed it entirely. It allowed countries to settle massive transactions instantly using a basket of currencies, African currencies, the Chinese yuan, maybe even gold, without ever touching the dollar or American-controlled infrastructure.
So they proved that global trade could flourish perfectly well outside the American financial orbit.
Precisely. And that strikes at the very heart of American global power. Investors saw this as the future, and they rushed to embrace African currencies and financial instruments.
And they even applied this independence to their commodities, to their most valuable assets.
They did. A consortium of key African states established a unified commodities exchange. So instead of selling their oil or gold or cobalt priced only in U.S. dollars.
Which has been the global standard forever.
Right. They prioritized pricing these critical resources in a basket of alternative global currencies. Washington had relied on dollar dependence for global leverage for decades, and now the world's leading producers of future critical materials were actively dismantling it.
So what does this all mean when you summarize the view from Washington? The painful realization must have been that this wasn't just temporary, this wasn't political.
No, the realization was that this shift was driven purely by superior economic logic. It was irreversible. Africa had built an environment that rewarded stability, clarity, and long-term growth.
The U.S.
The U.S. continued to reward short-term political maneuvering and financial volatility. The flow of capital was simply going where the opportunity was greatest, and the risk was, surprisingly, lower.
And the scale of that flow is what shocked everyone. Reports suggested nearly half of the investment funds once directed at the United States for things like infrastructure, mining, digital services were now going straight to Africa.
The global center of economic gravity is fundamentally shifting.
The world is now looking to Africa for the next wave of opportunity.
You know, Washington spent decades positioning itself as the indisputable global center, the place to be. Yet, within just a few years of Africa's coordinated transformation, that focus reoriented entirely. The U.S. has lost its safe haven status, and, well, it's likely permanent.
Which leaves us with a provocative thought for you to mull over. Given Africa's demonstrated unity, its commitment to industrial policy, guaranteed security, and its successful launch of non-dollar trade systems, if the U.S. cannot rapidly restore global trust, contain its debt, and resolve its crippling internal political volatility, does America risk not just losing its financial dominance, but permanently cementing its status as a